I appreciate all of your testimony. This is really important and thoughtful. If we can, I'd like to dive deeper into some of the findings in the Fed's post-mortem of the Silicon Valley Bank's collapse. The report made clear that the Fed failed at every step along the way, from the Board of Governors at the very top to the San Francisco Fed bank examiners on the ground, who were unwilling or unable to force SVB to fix its problems before the bank blew up. So let's start at the top with the Board of Governors. This is the body where bank rules are written and then communicated down to the reserve banks to enforce. One of the four causes of SVB's failure that the Fed report identifies is the 2018 law that Republicans, with the help from some Democrats, passed. This law severely weakened the guardrails that Congress put in place after the 2008 financial crisis to ensure that greedy banks never again crash the economy. That was certainly the intent. Dr. Conti Brown, you are an expert on financial regulation in the Fed. According to the Fed's Vice Chair Barr's report, how did the passage of that law, let's just call it 2155, that's what we call it around here, how did the passage of 2155, this bill that Congress voted on, lead to SVB's failure?
Thank you, Senator Warren. The provision in 2155 that refers to changing the asset classes is only about 5 pages long. It's very short. And it doesn't contain a mandate, Fed, thou shalt not supervise these banks. What it does is create a system that was in place under Dodd-Frank that for a bank to grow above 50 billion or above 100 billion, they knew that there would be significant regulatory and supervisory costs. Those costs went away because what Congress did is say anything below $250 billion is wiped clean. If you want to put it back, you got to go through a process. That's what they said to the Fed. And so for Silicon Valley Bank, which was hovering right below 50 billion at the time, that was just a massive neon light saying grow, grow, grow. So that was one way. And when they grew so fast, so far on both liabilities and on assets, they couldn't diversify. And so that led to flighty deposits that rendered them sensitive on the funding side. And it led to undiversified assets, which led to their collapse in this interest rate environment. The other thing that it did is send a very pointed direction. And as a historian of bank supervision, I'm currently writing a 600-page history of bank supervision that I'm nearly completing. I can tell you this is exactly the way Congress works. It writes laws and it says, this is the way we want you to use the tools, even when it doesn't say thou shalt or thou shalt not. And that's exactly the way that Title IV of the law is written. It's to say, pull back on this regulation and give a green light for massive and undiversified growth.
So the Fed report says that Congress told the Fed to deregulate, and that's what you're saying. This is the message that was delivered. The Fed heard that message loud and clear, and then it used that message to open up and start to deregulate even further throughout the Fed system here. And the result, according to the report, is that S2155 and the Fed's tailoring that it took in response, quote, this is from the Barr report, impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. And I think that's consistent with your testimony. Is that right, Dr. Conti Brown?
Yeah, it is.
Okay. So let me just then come over. Ms. Rodriguez-Valladares, you have decades of experience working as a bank examiner and training bank examiners. You're the one down on the ground with these folks who are making the calls with the banks every day. Do you agree with Vice Chair Barr's conclusion that S2155 promoted a less assertive supervisory approach?
Yes, very much so. And former Vice Chair Randall Quarles made it very clear before the American Bankers Association in the quote that I read that he really saw that Congress wanted these specific steps, and all of that is part of how, starting at the top, that tone, and filters all the way down to the different kinds of supervisors and examiners. And the tailoring rules meant that Silicon Valley Bank, for example, did not have to do a lot of incredibly important things, like really measure from a market perspective interest rate risks in the banking book, for example. It didn't have to do stressed liquidity coverage ratios. And so because it didn't have to do them, it didn't have to report them to the regulators or to the market. And that's incredibly important, because if the regulators miss it, but it then comes out in an annual report or Pillar 3, then the market can discipline the banks. And all of that, unfortunately, was missing precisely because of those tailoring rules.
So the loosening ends up having multiplier effects, that once you loosen a little bit, you lose other discipline in the system. Is that a fair way to describe what you just said?
Yes, absolutely. And not only that, but then all of the appointees at the Fed, at the FDIC, and the OCC as well, obviously, that was a totally different tone. When I used to go to banks right after Dodd-Frank was signed, I would see the bankers with all of the different compliance, all the rules earmarked. They took them seriously. So did the bank examiners. Mm-hmm. And that, after 2018, really disappeared. The tone changed.
Okay, so the tone changed. And here's another piece of it I want to look at. Not only did the Fed use the political cover that Congress gave it and moved in the direction of weakening the rules for big banks even further, the Fed itself was lobbying for the bill to weaken regulations the whole time. Fed Chair Powell testified in favor of it. And according to press reports, the Fed's general counsel may actually have even drafted it. Now, the members of Congress who voted for S 2155 and the banking industry that lobbied for it now argue that the Fed had the discretion to continue to apply stronger rules to banks like SVB. They just chose not to. And I agree. The Fed should have used its authority to apply stronger rules to banks with more than $100 billion in assets. And that is why I called on Fed Vice Chair Barr to use that authority immediately now, and I'm glad that he has committed to do that. But you don't get to write a law that shoves the Fed in a strictly deregulatory direction and then turn around and say, gee, we wish they hadn't deregulated. Dr. Connie Brown, do you think that the big banks and the people calling on the Fed to deregulate would have supported the Fed's decision? Take yourself back to 2018. Would they have supported the Fed's decision to use its discretion to strengthen rules for the banks with more than $100 billion in assets if they had decided to do that once 2155 had been passed?
It's inconceivable that they would have supported a move such as that. And I would go further still. In the 20th century, the 110 years that the Fed has been in existence, unlike, say, the SEC or the EPA, regulated entities under the Fed rarely, if ever, sue it.
Yep.
And that is for a lot of complex reasons. Bank supervision is related to it. This is a counterfactual, but I'd bet my eye teeth that we would have seen some very significant litigation. And the reason I think that is because Title IV is written in a way consistent with D.C. Circuit legal doctrine to invite litigation. And the reason is because it contains like a 7-part test that if you want to tread into the 100 and 250 billion range, you're entitled to do so, but you have to consider all of the following. And we have seen after the financial crisis with the SEC, similar kinds of language struck down by the courts. And so I think that the banks subject in this counterfactual to that kind of a regulation would have not called their bank examiners for a conversation. They would have called their lawyers to launch litigation.
Wow. That's a really powerful point about this. S 2155 weakened the rules and the supervision for these banks like SVB. and opened the deregulatory door for the Fed to drive a truck through, which under Chair Powell, it immediately did. The change in the law and the tailoring the Fed pursued in response to that change, quote, combined to create a weaker regulatory framework for a firm like SVB. And that is according to the Fed's own report. So, look, I am very glad that Vice Chair Barr has committed to using his existing authority to strengthen those rules for big banks. But Congress needs to close that door for good. And that is why I've introduced a bill to repeal Title IV of S 2155, which would undo the Fed's deregulation of the biggest banks and ensure that we apply tougher rules to banks like SVB that have the power to threaten our banking system.